Like and subscribe to my channel and click the bell icon to get new video updates.
Prior to the halt, Silicon Valley Bank stocks plummeted 87%. Why? What to do? A basic law of banking is, don't lend money to someone who can't pay it back, unless the borrower has collateral that the lender can sell to pay off the loan. This comes to mind when you read the Silicon looking at Valley Bank, the leading tech lender whose shares fell more than 2/3 of their value yesterday, until their shares were halted. This morning. SVB stock 5.44% of its shares are being sold short, fell as its depositors withdrawing their money in droves. To raise capital, SVB on Wednesday sold a bond portfolio at a loss and launched an emergency capital raise. SVB's future looks bleak unless it can stop a spike in withdrawals. SVB CEO Gregory wrote on Wednesday Becker in a note to customers that although customer deposits were lower than forecast in February, the bank was pleased with the financial situation, e.g. to weather the ongoing market pressures, according to the NYT of the New York Times. Reported the New York Times. With other bank stocks suddenly falling, it may be time for banks to consider raising the interest rates they pay depositors, otherwise they could take their money out of the banks and into higher-yielding money market funds. SVB, which keeps making deposits and lending to startups and venture capital firms, had lost 87% of its market value between March 8 and 10. While the stock closed down 60% on March 9, the stock plunged another 65% in the previous month's market trading, before the shares halted trading, according to the Wall Street Journal. In response, CNBC reported that SVB had failed in its attempts to raise capital and had hired consultants to explore a possible sale. Continue here. Why are investors selling SVB shares? According to the New York Times, they fear that the bank will not have enough capital to meet its obligations. It announced on March 8 that it suffered a $1.8 billion loss on asset sales, $21 billion of relatively liquid low-yielding government debt, according to The Wall.